Okay, I think we can make a start. Good morning, good afternoon, good evening, everyone, wherever you might be. I'm Stelios Violaris, PwC Cyprus's International Tax Services Leader. Thank you all very much for joining us on this webcast of ours. We appreciate it a lot for taking time out of your busy schedules and really hope you will find it to be 45 minutes of good value at the end of it. The global anti-base erosion or GLOBE rules or Pillar 2 rules, as they are commonly referred to, is the OECD driven project aiming for a globally coordinated system of taxation intended to ensure large multinational groups pay a minimum level of direct tax. It is really a generational change, the first of its type, and it impacts corporate groups that record more than 750 million annual revenues. And really what Pillar 2 does, it ensures that such groups, constituent companies, pay an additional tax to that paid domestically, so to reach to that minimum rate of 15% on their accounting profits in each and every separate jurisdiction in which they operate. Therefore, additionally to domestic tax considerations that inevitably arise with respect to the activities of a multinational group, we now need to layer on top the Pillar 2 rules, which come along to effectively neutralize the tax incentives companies usually get through local tax laws and which help them end up with local taxable profits, which in many cases are much lower than their accounting ones. The Pillar 2 regime is so far-reaching that it actually impacts group companies around the globe, irrespective of whether some jurisdictions in which they are located might not have adopted at all, or they might be delaying to adopt the rules themselves. The rules are voluminous, complex, and they require data from various sources. Accordingly, it requires a cross-functional team to be able to develop the processes, the systems, the technologies to be able to address and comply with these rules. The data required to do these calculations is unprecedented and provides a real challenge to achieve readiness. So over the next 40 minutes or so, we will try to give you at high level a good understanding of what the rules are all about, together with our view on how the matter could be approached, leveraging, of course, from our experiences so far. So at the end of it, you can hopefully appreciate fully the challenges and complexities involved. Before I hand over to Cleo, who will be navigating us through the sections themselves, I feel I need to emphasize that Pillar 2 is already a reality and upon us. 18 EU member states, as well as many other third countries around the world, have already introduced their respective Pillar 2 laws. We as Cyprus have not voted in the relevant law yet, but being an EU member state, we will need to do that as soon as possible. We know the Ministry of Finance are working hard together with the legal service, so the draft law can hopefully go to Parliament as soon as it is back from its summer recess. And importantly, once it's enacted, it will apply retroactively. So practically as from January 1st, 2024, as provided by the relevant EU directive. Okay, that's it from me as a quick introduction. Cleo, over to you, please.
Thank you, Stelio. And good morning, good afternoon, good evening from me too. My name is Cleo. I'm a partner heading the tax compliance services for PwC Cyprus. And as Stelios said, I will be navigating you through the various sessions that we have this afternoon for you. So who you will be hearing from this afternoon, you have heard from Stelios, who is the tax advisory partner in charge of Pillar 2. I'm the tax compliance partner in charge of Pillar 2. And with us today, we have Stavros, Joanne, and George from the tax advisory team, and Nicolas from the tax compliance team. Stelios has mentioned that this is a complex legislation. I would summarize what he has said. In my mind, it's the most complex tax legislation I've seen in my 30-plus year in tax, in the tax profession. So what we're trying to do this afternoon is just to break it down for you, to make it easier for you to understand. If you have questions as the sessions progress, please post the questions in the Q&A session. We'll have dedicated time at the end of the webinar to answer as many as we can of your questions. And now let's have a look at what the agenda is. So we have heard from Stelios. The next session is headed by Stavros, who is going to take us through an overview of what Pillar 2 is. We'll move to Joanne, who is going to talk to us about what's happening locally in Cyprus. Back to Stavros for more information on what it means to be ready and what it means to comply with Pillar 2. And we'll finish with George and Nicolas giving us a taste of how can PwC help you both in the tax advisory space, compliance, as well as technology space. And then, of course, we'll finish, as I said, with the Q&A. So with that, I will pass you over to Stavros to give us an overview of what Pillar 2 is all about.
Thank you, Cleo. I think before we start, because we will be using a lot of these terms interchangeably throughout this presentation, I think it's good to start with some key terms. So when we're talking about an M&E, we're talking about multinational enterprises. If we're talking about a UP, we're talking about the ultimate parent entity of a group for Pillar 2 purposes. The IIR is the income inclusion rule, which is the primary rule for levying the Pillar 2 top-up tax. The UTPR is the secondary rule for levying the Pillar 2 top-up tax. We'll talk about how these two interact in a few minutes. A QDMTT stands for a domestic minimum top-up tax, with the Q in brackets representing the qualifying status of the DMTT for Pillar 2 purposes. We will see again why this Q makes a difference. And also when we're talking about a constituent entity, we're talking about an entity which is part of a Pillar 2 group. You've heard from Cleo and Stelios that these rules are quite complex. The provisions describing these rules are voluminous. And I would describe personally these rules as revolutionary. It's the first time ever in international tax practice that you've got an initiative of this kind, because this effectively introduces a new tax regime that imposes a 15% minimum effective tax rate on the adjusted accounting profits of M&E groups with global turnover above 750 million euros for at least 2 out of the last 4 fiscal years immediately preceding the tested fiscal year. So for 2024, for example, you will need to go back to 2020 and see whether in 2 out of these 4 years you exceeded the threshold. What is important to note here is that the 15% tax rate applies to profits of each jurisdiction in which the group operates. Is very important. So if you're looking at your consolidated financial statements and see a high effective tax rate, that does not mean that you won't have any top tax to pay. You actually need to go into detail into each jurisdiction you're operating and see whether the 15 minimum tax rate of Pillar 2 is met. Again, important. If you see that on the basis of the tax you pay and the local tax provisions, the ETR is higher than 15%, it doesn't mean much. You need to do the calculations in accordance with Pillar 2. Having said this, there are certain excluded activities and incomes which include, amongst others, specific types of shipping income, dividends, and capital gains not relating to portfolio shareholdings. And also, there are excluded entities, government bodies, international and not-profit organizations, pension funds, investment funds, and real estate investment vehicles, and with certain conditions, their subsidiaries. What you're seeing here basically is a snapshot of what has happened over the past 3 years with respect to Pillar 2. But actually, this is a process that started 10 years ago, back in 2013, when the OECD intended to address the issue of base erosion and profit shifting. As you may recall, this resulted to a number of deliverables during 2015, which addressed tax avoidance in a number of ways, and also it provided for certain information exchange methods that would help tax authorities address this issue. Coming now to Pillar 2, the first draft of the actual GloBE rules were presented during December 2021, with the draft EU directive implementing them coming soon after. During 2022, there was a commentary and administrative guidance being released, and also the draft directive was approved in the EU. During 2023, there was more administrative guidance coming in, and in 2024, as Stelios said, effectively, the IIR is applicable. So as from 1st of January 2024, for groups that have a fiscal year that follows the calendar year, you're within the Pillar 2 rules. So when do I report? This is 18 months after the relevant end of the fiscal year. So you would be expecting to file your first GloBE information return in June 2026. And thereafter, from 2025, the deadline for submission of the GloBE information return reduces to 15 months after the end of the relevant reporting fiscal year. So if your fiscal year corresponds with the calendar year, you will have to report by March 2027 for 2025. So what are these GloBE rules we're talking about? What do they mean? How do they work? So these are two interlocking rules. What do I mean by this? They complement each other. So the income inclusion rule is payable by the ultimate parent entity in the jurisdiction where it is, or if the jurisdiction where the UP is situated does not implement the Pillar 2 rules, then this will cascade down to the immediate parent that actually applies the Pillar 2 rules. The logic of the Pillar 2 of the IIR is similar to that of a CFC rule. So the UP will see downwards, will see each jurisdiction, will see whether any top-up tax needs to be collected, and will collect it at its jurisdiction, so the UP jurisdiction. This rule takes precedence over the UTPR rules, which we will be talking in a minute, and is effective for financial year starting from 31st December 2023. So effectively, from 1st January 2024 for the majority of groups which follow the calendar year. As you see in the picture, this is a top-down tax. On the other hand, the secondary rule, the UTPR, acts as a backstop if actually the IIR does not apply. And this, the difference between the UTPR and the IIR is that the tax that is considered as low for one jurisdiction can actually be collected by more than one jurisdiction. What you need is that you need to have a Pillar 2 group, and you need, in this jurisdiction, you need jurisdictions that actually apply the Pillar 2 rules. So if there are more than one jurisdictions that apply the Pillar 2 rules, and there is no top-up tax being levied pursuant to the income inclusion rule, then the UTPR comes into play. How is it paid? There is no prescribed method, such as the income inclusion rule, which is a top-up tax. So it can either take the form of a deduction of expenses, for example, or of a top-up tax, like the IIR. How is it allocated? So the tax is allocated in jurisdictions on the basis of certain allocation keys, based on the basis of total employees and tangible assets, which are situated in each jurisdiction. We'll see a scheme later on how these rules work. So again, if you see the picture, this is a tax that can be applied, levied anywhere in the group. The obvious question here is, okay, why did countries accept this, because inevitably some tax that is rightfully theirs in accordance with the Pillar 2 rules will be, in fact, collected somewhere else. So this is why both the model rules and the EU directive give the possibility to jurisdictions to introduce a domestic top-up tax. So they levy this 15%, any top-up tax that needs to be collected to reach this 15% locally. The OECD has described what a top-up tax is considered as qualifying for its purposes. What does it mean? If it's qualifying, then any top-up tax that was paid in a jurisdiction can be credited against the IIR liability at the level of the UP. If, though, certain further conditions are met, then the QDMTT will be eligible for the safe harbor, which will mean that the method that the double taxation from this from Pillar 2 will be alleviated through an exemption. Practically, this means that you will only need one calculation at the safe harbor QDMTT jurisdiction, as opposed to two, where you have a QDMTT non-safe harbor and the application of the IIR. So how we try to summarize in the easiest way possible on how the rules actually work. So at first level, you need to check whether domestic top tax has been implemented. If yes, you will need to follow the rules of that domestic top tax, calculate and pay. At the second level, you will apply the IIR at the level of the group UP. So for example, in our example, country A will levy the IIR, but if a QDMTT was levied in country B or country C, then the QDMTT will be credited or exempt if it's a QDMTT safe harbor tax. Level 3, if on the other hand, country A, where the UP is situated, has not implemented the Pillar 2 rules, and for example, country A is a low tax jurisdiction, then the tax that should have been levied at country A level will be collected effectively by country B and country C on the basis of the allocation keys we discussed before. I think the message up until now is that the rules are very complex to comprehend and also to apply. You will see later that there is a plethora of data points that need to be collected in order to be able to make the relevant calculations. The OECD has recognized it and has provided for simplified calculations for Pillar 2 purposes on the basis of your CBCR report. Some adjustments need to be made, but if you meet these safe harbors, then the top-up tax will be considered as zero at that jurisdiction. There are also safe harbors with respect to the application of the UTPR if the UP in the UP jurisdiction, and also there is the permanent QDMTT safe harbor, which we discussed before. And at this point, I hand over back to Cleo.
Thank you, Stavros. So to summarize, basically, if you are unlucky not to be an excluded entity or have exempt income, and you have income more than 750 million, then you're caught by the rules. If your effective tax rate globally at consolidated level is above 15%, that's not good enough because you need to check every single jurisdiction you operate in. First reporting would be for 2024. As Stavros said, it will be done mid-2026. That's 18 months if you're on the calendar entry, and then thereafter 15 months after the year end. For 2024, the top-down income inclusion rule will kick in. It's like CFC, it's applied by the parent. From 2025, the under-tax profit rule comes into effect, is applied by the family, not just the parent, by companies that are in countries that apply Pillar 2 rules. Of course, you have the local top-up tax. And in terms of what order do you apply this, it's first the domestic top-up tax, then the income inclusion rule, and then the under-tax profit rule. And of course, finally, you have safe harbor simplification rules. CBCR and UTPR are transitional. and then QDMTT are the permanent simplifications. So now we move to Joanne, who is gonna take us from global to local and explain what's happening here on the ground in Cyprus. Over to you, Joanne.
Hello, thank you, Cleo. Hello from me. So where does Cyprus stand on Pillar 2? Well, currently there is no Pillar 2 law in place in Cyprus. Cyprus is, however, required to enact the EU Pillar 2 directive into local law. And to this end, in late 2023, a draft bill was published by the Cyprus authorities. The draft bill was open for public consultation for a period of approximately 1 month, but that has now closed. Our expectation is that Cyprus will enact Pillar 2 into local law soon, perhaps in early autumn. Now, what are we expecting to see in Cyprus? Our slide here is based on the public consultation draft. So first, we have the income inclusion rule. That is expected to apply from the beginning of 2024 and for future years. And that is despite it not yet being enacted. Then turning to the undertaxed profit rule, that is expected to apply from 2025 and onwards, so not from this year. The same is expected for a Cyprus domestic top-up tax. That is expected to apply from 2025 and onwards, so again, not from this year. And the expected Cyprus domestic top-up tax is expected to mirror the calculations for the income inclusion rule and the undertaxed profit rule. Finally, for the safe harbours, Cyprus is expected to apply all the safe harbours which were mentioned earlier to the 3 rules mentioned above, the income inclusion rule, the undertaxed profit rule, and the Cyprus domestic top-up tax, where the relevant conditions for those safe harbours are met. So in summary, we expect Cyprus to have in place a Pillar 2 law relatively soon, with an income inclusion rule that will apply for the whole of this year. And the law will also include compliance, filing matters, and payment matters as well. So with that summary, I will hand back over to Cleo.
Thank you, Joanne. I don't think a summary of the summary is needed. I think it's pretty clear what's happening here in Cyprus. So the law is coming and we need to get ready. So we're now going back to you, Stavro. And I have a question for you. If we're reporting in 2026 for 2024 and we're now in 2024, why all the rush to have this webinar? Why such a big need for people to prepare?
Thank you, Cleo. This is a question that we get asked more often than not. So there are actually a lot of reasons why you should, if you haven't started, you should be starting with your Pillar 2 compliance soon. So the first reason is if you're a group which is caught or you expect that you will be falling within the provisions of these rules soon, you will need to report to management and actually disclose to management what is the expected impact of these rules to your group. Additionally, if you're within scope, or again, if you expect to enter within scope, you will have some provisions that will need to be booked in your financial statements. So you will need to have discussions with your auditors as to how these provisions will be booked and what audit trail they need in order to ascertain that your provisions are actually correct. So this is a compelling reason why you need to be starting soon with Pillar 2 compliance. And additionally, as you know, as groups reach towards the year end, the need to actually close the financial statements becomes imminent, and you lose also traction and the focus of other teams to assist you with this gigantic task. The other reason is that, as Stelios said, the Pillar 2 rules introduce a new layer of taxation. So there are new rules on top of the existing rules. So if you're trying to enter into an M&A deal, then these rules, these complex rules, will need to take into account in the diligence modeling and structuring of your M&A deals, as the Pillar 2 rules will have an impact on the way that the transaction is done and the transaction documents are drafted and negotiated. Also, importantly, M&A deals may bring groups which prior to that deal were not within the Pillar 2 rules into the Pillar 2 rules. So the impact and the application of the Pillar 2 rules will need to be factored in also in the decision whether to enter or not into such deals. And the last but quite obvious, Pillar 2 will likely lead to an increased tax output for the group. So the majority of groups will have an additional tax to pay, depending though on how much, on where they do business, whether they use incentives or not. So this is actually a thing that needs to be taken into account. That is why you need to start preparing now. Preparing for Pillar 2 is not easy. So I'm not asking you an easy feat. This is a big exercise and complex one. What we've seen from experience with our clients is that the data is there, but not in a way that is structured and easy to extract. Why? Because systems or groups, they did not prepare themselves for these rules. They were not designed in this way. So these rules come on top of their usual conducting of business. So what we usually see is, in many cases, lack of discrete legal entity pure data. So what do I mean by that? You've got a head office with permanent establishments in various jurisdictions. In a number of cases, you don't have discrete data for Pillar 2 purpose for these permanent establishments. And since these permanent establishments are separate constituent entities for the purpose of the rules, the availability of the data is very important. Also, with respect to taxes, if groups don't use a specific tax provision software, this information is scattered and it's not available in a way that is easy for group controllers to get. Another issue that needs to be taken into account is that there is often a misconception that since the starting point for the Pillar 2 rules are the accounting results of the group, that everything can be extracted from a group's consolidation package. This is not true. As Nicolas will say, only a percentage of the data required for full Pillar 2 compliance can actually be found in your Pillar 2 in your consolidation package. And as a separate point, we discussed before about the CBCR safe harbors. There is a lot of information that needs to be, let's say, vetted in order to ascertain whether actually your CBCR report is compliant for Pillar 2 purposes. So again, this is a smaller but also very relevant exercise that for Pillar 2 purposes that needs to be undertaken, because in actual fact, the CBCR safe harbors can assist to cut through the complexity, to reduce the complexity of these rules and let groups focus on the jurisdictions that are actually needed to do the detailed calculations. So this is, I hope I convinced you, Cleo, for the need for to start preparing now.
Thank you, Stavros. So in summary, the answer to my question is there are two main reasons. Number one, you need to budget for increased tax. And number two, that systems need to get ready to gather the data. So increased tax needs to find its way into the provisions that are being made in the financial statements, especially if you're reporting mid-year. If you are not caught by the rules because your turnover is below 750 million, but you are in the middle of a restructuring or you're planning a merger, then you need to consider whether that will push you over the threshold of 750 million, as Stavros said, and then consider the increased tax cost in the calculations you're making. And last but not least, data gathering can prove very difficult, especially if it's coming from various places which are not aligned with the head office, and you need to collect all this data to run the calculation. So yes, Stavro, I have been convinced that this is urgent and we need to act now. So acting now, we are now moving to George and Nicolas, who are going to tell us a little bit about how can PwC supports you both in the advisory space as well as a compliance space, both at the software, if you like, the people supporting you as well as technology supporting you. So over to you, George and Nicola.
Thank you, Cleo, and good afternoon from me, everybody. So moving on to the next section of how we can help. So first and foremost, we can provide support from a tax technical standpoint, and this can be in the form of either physical or virtual trainings in order to get your key company stakeholders up to speed with what Pillar 2 is. Also, it can provide ongoing legislative updates as and when these are available, along with any technical interpretation of relevant areas that might be interesting for your business. And as a final point, we can provide tax technical consulting services, and this can be in the form of ad hoc advice, which focus on specific areas of the Pillar 2 realm that are relevant to your specific fact pattern. Now, moving on to the next slide, which is all about compliance and reporting. So there are 4 key steps when you think about compliance and reporting that we have been working on with client groups to help approach readiness for Pillar 2. And it's important to mention here that these 4 steps can be performed in any order, and that depends, of course, upon your priorities and your desired outcomes. So going into each step in a bit more detail, starting from the constituent entity analysis. So here we can assist you in assessing which entities from your structure will be considered as constituent entities for Pillar 2 purposes. And for these identified entities thereon, we can assist in compiling the entity's master data, which includes, amongst others, the name of the entity, its tax residency, its nature of business activities, and its hierarchy within the group structure. It's important to note here that completeness and accuracy of this data at all times is vital, as this will help with the accurate provision, compliance, and also for any modeling purposes. Now, moving on to the safe harbor analysis step, here we can provide assistance in determining which jurisdictions from your group qualify for any of the transitional safe harbors, as Stavros discussed a bit earlier, and thereon to assess any relevant benefit. And this step is facilitated by the use of an internal software tool called Safe Harbor Analytic. Going into the data and systems assessment step now, the next step, here we assist you in assessing your systems, your data structures, and also your data sources in determining how to collect the data that is required for the Pillar 2 calculations. I will not delve deeper here. My colleague Nicolas will provide a bit more color as part of the next section. And as a final area, the impact assessment step, which leverages on the data obtained from the data and systems assessment to perform the detailed calculation via the Pillar 2 engine, and thus determine the preliminary impact, Pillar 2 impact, that is, for the group. Now, passing on to Nicolas to delve deeper into how we approach Pillar 2 from a data standpoint. Over to you, Nicolas.
Thank you, George. So, hi from me as well. Taking into consideration the number of Pillar 2 challenges already mentioned today, its global impact and the multitude of teams involved, that's both internally and externally within our organization, we have developed a comprehensive approach to make it as straightforward as possible for any group, irrespective of size, operations, and global presence, to achieve full compliance. At a high level, this approach is broken down in these 4 key pillars. We start with the operational readiness, where we assess basically the readiness of your organization in terms of systems, processes, and data for Pillar 2 calculations. Then we have the data input catalog, which is a repository of all information necessary to perform Pillar 2 calculations. the actual engine, the Pillar 2 engine, which is our tax engine to quantify potential impacts of Pillar 2 and execute complicated compliance calculations, and of course, the outputs. Now let's dive deeper into each of these components, starting with the operational readiness. Pillar 2 is such a heavy data exercise, and there is so much reliance on non-tax teams that you need to make sure that you have a dedicated data strategy in place for Pillar 2 purposes. Key questions to address during this phase include: what data do I need? How can this data be identified within my systems? How can this data be sourced, and who is responsible for each data point? How do I identify any data gaps, and what actions should be taken to address them? And how can we execute the relevant processes efficiently? The next one is the data input catalog. This is a comprehensive collection of all various data points needed for Pillar 2 calculations. Based on our latest version, we have identified 285 data points required for each constituent entity, depending, of course, on their applicability. And from our experience working on Pillar 2 projects, and this is globally confirmed working with other clients globally, approximately 50% of the data points can be found within your trial balances. This is an ERP, an entity ERP, or a consolidated system. Around 30% can be sourced from a tax provisioning software or relevant work papers, and the remaining 20% relate to non-financial or non-structured data, such as deferred tax calculations, HR-related data, and other manual adjustments or analysis. So in a summary for the first two steps, we provide you with a very detailed catalog of what is needed per constituent entity, assess the applicability of this data, identify which data can be extracted from your ERP or other software, and determine how to gather and complete any missing data. After the data analysis, identification, and gathering are complete, we then move into the actual calculation phase, which is handled by our Pillar 2 engine. This is basically a centralized rules engine, which is built by our Pillar 2 experts globally, and includes jurisdiction-specific rules and calculations. And this is very important. This is continuously updated as local laws are drafted and implemented worldwide, ensuring quality and consistency. This robust calculation engine computes local territories rules with a global overlay. In a summary, as long as you feed the engine with the required data, then all Pillar 2 calculations are performed automatically, taking into consideration the jurisdictions you operate and the specific elections you make. The final step involves getting the required reports for submission to the relevant authorities, along with providing a full audit trail and dashboards to visualize the impact of Pillar 2. Now, all these can be presented in the next slide, which is an overall approach of what is described above. So we start by identifying your data sources and your overall data strategy, which is the first column on the left. Then by using data accelerators, extraction tools, we automatically populate the data input catalog with all applicable data fields for each constituent entity. This catalog is then fed into the Pillar 2 engine to perform the required calculations and prepare all statutory requirements, visualizations, audit trails, or any other custom reports we are required to. And moving on to the final slide, this outlines basically the various support models we offer depending on your needs. The first one is the managed service approach, where all calculations are performed by PwC. You are responsible for maintaining the data internally, and we collect the data, feed it into our Pillar 2 engine, and deliver the reports back to you ready to be reviewed and filed. The second model is the licensed product, where you license the Pillar 2 engine and perform all calculations in-house. We support you with implementation services, as well as the operational readiness and data input catalog phases. Thereafter, the responsibility lies within your organization. Next one is the co-source option, where you license the engine, but we run the calculations on your license. Then is the software license option. Here is where you use a third-party software for Pillar 2 calculation and receive support from us for that. And finally is the client build model, where it's used to build your own tax engine, basically. Although the option is available, we don't recommend it due to the significant development and implementation costs involved. As a closing remark here, I just want to highlight the fact that we can offer A to Z support on your Pillar 2 requirements, of course, tailored to your specific needs. That's all. Thank you very much. Cleo, this is over to you.
Thank you, Nicola. Thank you, George, for the useful information. So in summary, we can train you to do it, we can help you to do it, or we can just do it for you. George and Nicolas have explained, that we can apply the tax knowledge we have to help you apply the rules and comply, both in terms of technical expertise as well as technology expertise. We can help in gathering the data, throw it into the engine and run the calculations for you so you can have a peace of mind. And the tool, as Nicola said, is quite unique because it's a global tool constantly updated from all the territories around the world. That's all we had to say. We are now going to the final section, which is all about what you had to say. That is what you want us to say extra over and above what we have already said. So that's your question. So I will now pass back to Stelios to run the Q&A session and close the session for us. Over to you, Stelios.
Thank you, Cleo. So we're like 42 minutes almost in it. We've got some good 3 minutes, but maybe we can overrun a bit because there's quite a few questions coming in, actually. One question that definitely I want to address says here, can the slides be circulated to the participants right after the session today? Absolutely, we can do that. So please expect a cover email with a slide deck in its entirety coming through to you before the close of business today. So straight into what's coming. Are holding companies affected by the rules? It seems not, but it would be good to clarify. I think Stavros, this is one for you, please.
Thank you, Stelio. As we said a bit before, there are some exemptions to the rules with respect to specific items of income. So if your holding company, the only thing that has is it has participations in subsidiaries with, 100% or nearing 100%. And also these subsidiaries are held in a long-term horizon, then yes, these incomes would be exempt, also in accordance with Pillar 2 rules. The only thing that I need to note here is that even though this income would not be taxable, you will still need to do the calculations to show that you're compliant with Pillar 2 rules.
Okay, thank you, Stavro. On to the next one, we have operations in a number of jurisdictions having higher than 15% rates. Is it safe to assume that we should not focus on these jurisdictions? I think, again, Stavros, for you, this one.
Yeah, thank you. No, so it's definitely not a safe route to follow. Even if there is a nominal tax rate exceeding 15%, we've seen cases, practical cases, where there were higher tax rates, nominal ones, but groups were utilizing of specific incentives in those jurisdictions, which for Pillar 2 purposes drove the ETR well below 15%. So we would definitely not recommend following this approach. I think doing a proper evaluation of all your operations in all jurisdictions is necessary.
headline tax rate doesn't mean much for Pillar 2 purposes. I think that's the takeaway on this one. Okay, next one. We have just started exploring whether our group might be eligible for any of the transitional safe harbors, but it is a time-consuming exercise. You made mention of a safe harbor software. Can you explain a bit how this works, please? George, maybe this is right down yours.
Yes, thank you, Stelio. Yes. So yeah, the Safe Harbor Analytics software. So what this is a tool that helps the process of determining which jurisdictions in your group qualify for any of the transitional safe harbors. And the way it does that is it takes your group's financial and tax data into account and identifies the qualifying jurisdictions in which the potential benefits apply. It also provides some actionable insights, allowing you to make informed decisions quickly. So I think the takeaway here with this tool is that it's a tool that greatly simplifies the process of determining transitional CBCR safe harbor eligibility and saves times in doing so, as time is of the essence with transitional safe harbors in particular.
Okay, thank you, George. We're past the 45-minute mark, but I think let's keep it for a little bit longer to try and cover a little bit more, maybe another 5 minutes, and then we close. Okay, I've got a wishful one thing here. Has the OECD inclusive framework finished issuing their guidance on the Pillar 2 minimum tax rate, or tax rules rather? Joanne, I think this one's for you, please.
Thank you, Stelio. Wishful question. So no is the short answer. The administrative guidance that the OECD inclusive framework release is very important because it's used to interpret the rules. And since the rules and directive were issued, there has been a number of administrative guidances issued. And actually there was one issued just last month in June. And we are expecting further administrative guidance to be issued within 2024. So it's important to note that we have a lot of administrative guidance, but the final interpretations are still taking shape as more guidance is released.
Right after the summer holidays, I would have thought they're going to come back with more guidance. Okay. What processes and systems does PwC recommend for maintaining ongoing compliance with the Pillar 2 rules? How can this be integrated into our existing operations? Nicola, I think this is for you, this one.
Yes, thank you for the question. Of course, there are a number of processes and systems that need to have in place for Pillar 2 purposes. I'll just highlight one system and one process, basically. First of all, you need to have a tool, a tax engine, to process all the required data and produce the final reports. Due to its complexity, this is not something that can be developed and performed in a spreadsheet. For example, PwC, we have developed our own Pillar 2 engine, which we have already discussed before. Of course, there are other solutions out there. There are standalone softwares or as modules to existing softwares and ERPs. What I would suggest here is for any solution you may consider to ensure that there is a mechanism for updating to capture the relevant Pillar 2 rules and tax treatments as local legislation is enacted globally. If this is not done automatically, then you need to ensure that you have someone responsible to follow up on these developments and keep updating. There are also some other processes you need to implement. I will just highlight, so for example, if you do decide that you keep the data and you do it, as you have already discussed, around 50% of the Pillar 2 data is not coming through an ERP. So you need to have a process in place so that someone is responsible to identify this data, collect it, and provide it to the Pillar 2 team, and be ready for uploading this in whatever tool and system you choose.
Thank you, Nicola. Next one. I understand that the starting point of Pillar 2 are the financial statements. In our case, we're a multinational group with different jurisdictions having different accounting standards. What is our starting point? Do we use a bit of everything? George, maybe this one, please.
Yes, thank you, Stelio. Definitely not a bit of everything. There's always a starting point with Pillar 2, although it can get a bit complicated. So the primary basis is the generally accepted accounting principles, or GAAP for short, of the ultimate parent entity of the group. And this means that the consolidated financial statements prepared under the GAAP of the jurisdiction where the parent entity is resident will generally be used to determine the accounting standard to use. So say you are a Cyprus headquarter group with a Cyprus ultimate parent entity, and you prepare consolidated affairs under IFRS at that Cyprus ultimate parent entity level, then IFRS should be your accounting standard to use. Now, having said that, there are a number of exceptions to this rule. So for any particular fact pattern that you might have in mind, I think it's better to take this question offline.
Okay. Thank you, George. One last one, I think. I'm hearing that there is to be another EU directive on the Pillar 2 minimum tax called DAC 9. What will be the point of DAC 9 since we already have the Pillar 2 minimum tax directive? Good one. Joanne, maybe?
Thank you, Stelios. I'll try and be quick on this. DAC 9 is expected, so a second directive on Pillar 2 is expected. DAC 9 is expected to focus more on compliance matters. So it's expected to focus on what taxpayers will need to report to their local authority within the EU, and also how tax authorities within the EU exchange information between them. But just to say, whilst it's expected to focus on compliance, it's not expected to harmonize all compliance. So each individual member state may have their own rules covering, for example, notification when you're in scope or payment dates. So DAC 9 will be a compliance directive, but additional compliance expected in each member state too.
Okay. Thank you again, Joanne. We're overrunning a bit. Our time is up, really. So this last question and answer marks the end of our webcast. I mean, obviously, there's a lot to digest and think about. More than anything, I'd say the readiness that needs to be achieved so that one ensures full compliance with the laws, the rules, the regulations, which are everywhere. We do hope that we have given you some good insights as to how you could be approaching the task ahead. And of course, we remain for any one-to-one discussions you may wish to have on the way forward and the specifics of your companies and group. Again, thank you very much for participating. Thank you to the presenters, obviously, and wish you all a good rest of the day ahead. Bye-bye.
Bye-bye.